no one is talking about how much we're going to use of electricity because of AI, and the grid problem. The grid is not ready for that, and the onshoring, and all these things are going to create a huge demand for metals, in my view. And I think silver is going to participate that in a big way. And so, there's two ways you can look at this chart: the gold and silver. You can say, "Wow, what an opportunity!" That's the way I see it. And there's other people that will say, well, this time is different, Tavi. Well, maybe the blue line is going to stay there because, don't you know that silver is not what it used to be in the past? I don't believe in those things. I bet on history. And if I'm wrong and this time is different, it is what it is. But I'm definitely not expressing, I'm expressing my view very strongly that the blue line is going to rise. And so, and I'm willing to take that bet with history on my side.
Tavi Costa notes that as capital increasingly flows into gold, silver is poised to be the next logical beneficiary. While silver has not outperformed gold in recent years, it has still delivered respectable gains. The common perception that silver has underperformed stems largely from its failure to match gold's momentum, rather than an actual lack of appreciation for it. On Friday, silver surged to a new decade high, reaching nearly $36.20, and continued its strong upward trajectory. Market analysts have labeled it a value buy, pointing to its long-standing underperformance relative to gold. This growing interest is underpinned by a structural imbalance in the silver market, with Commerzbank analysts noting that it has remained in a supply deficit for 5 consecutive years. Although the deficit is expected to narrow slightly due to a possible decline in demand and marginal supply increases, the broader picture still supports a bullish outlook. Historically, easing geopolitical tensions have dampened demand for precious metals as safe haven assets. However, silver's dual role, as both a monetary metal and a critical industrial input, sets it apart in the current macroeconomic landscape. Industrial demand for silver is expected to increase, driven by its crucial role in high-growth sectors including electric vehicles, semiconductors, and mining technology. Costa emphasizes that silver is positioned to benefit from broader structural shifts not seen in previous commodity cycles. These include the surge in AI-driven energy usage, increasing strain on power grids, and the reshoring of manufacturing to domestic economies, all of which significantly increase silver consumption. Technically, silver's breakout above the October 2022 high of $34.87, which now serves as key support, reinforces the strength of the current rally. The 20-day exponential moving average, advancing near $33.85, suggests sustained bullish momentum in the near term. As gold leads capital flows, silver is emerging from the shadows, catching the attention of investors, recognizing its undervaluation and growing strategic importance. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think it's always, my view of markets is usually you kind of have this, what's the easiest asset when you start seeing these big shifts in the macro. Some of the easy assets to attract capital will be the first ones to benefit from those changes. In case gold is the easiest one to understand the case, right? I mean, it's got centuries of history, has played monetary role like no other metal. It's been always held by central banks. So to your point about, we had prior times when the dollar turned, why not this time gold won't work and the dollar turns, just like prior times that we've saw this in the past. And you're not wrong, but you have to understand as well, perhaps in my view, that there's sort of a long list of reasons why gold is entering a long-term bull cycle, in my view. And some of them are what's happening with central banks. Central banks back during that time that you referred to when gold did not work and the dollar turned, central banks were loaded with gold at that time in their balance sheets. They held close to 75% of their balance sheet in gold at that time. Do you know how much it is today? Less than 20%. So it's a drastic difference of capital allocation. Then look at family offices or just pension funds and all these large institutions. They barely own gold. In fact, they barely own silver, copper, commodities, miners, resource stocks. Why? Because they haven't worked. And so outside of gold. And so, as things start to change and the easy asset attracts the capital, people start saying, all right, well, what's the next gold now? And the next obvious gold, in my view, is silver. it has been performing well. It's not like people tend to, and this is the case, by the way, with most ideas that I like, and I start growing conviction, is when you present an idea and people get back to you and say, well, you could have said this 20 years ago and nothing would have happened. I wasn't saying this 20 years ago. I've been saying this for a year, maybe 5 years ago, 4 years ago. And gold has been moving like never before. And silver, it's not like it hasn't performed well. It has performing okay, just hasn't performed as well as gold. The miners, for instance, have outperformed S&P 500 over the last 10 years, dividend included. And it's remarkable to see the skepticism over this industry, despite the fact that performance is already outpacing the market itself. And so, and so you have to kind of look at this with the lenses as well of the depressed capital in the mining industry. Production, where is production of gold? Where's production of silver? Are we going to see new mines come online and change the supply curve? No. And we also know that most of the capital that the miners are making, what are they doing with that capital? They're paying back dividends and buybacks and returning the capital back to shareholders. They're paying down debt. And so, nothing is changing the supply curve whatsoever for the next 5 to 10 years, given the timing it takes for an investment to actually translate into new supply. So all these things are big macro changes that are likely to be adding to the fuel to this secular bull market in metals. And then another point to point out as well is the deglobalized environment that we have entered. It just happens to be the case, not a coincidence, is what I'm trying to say, that you enter a deglobalized environment as you have excess of debt in globally as well, and that's just normal. When you have too much debt, you start seeing a diminishment of growth. And as you see that, it's harder to be a politician. And then politicians begin to become more populist. And that's when you start seeing changes in the whole deglobalization environment. And so I am a firm believer that's just, sort of, we've seen maybe the early stages of this, but there are long legs is still occurring here in the next 5 to 10 years in a deglobalized environment. And so all these things sort of point to metals. And there's another point that I didn't even mention here that I think is probably the most important one, is the potential for a black swan event in things like shortage of electricity. No one is talking about how much we're going to use of electricity because of AI and, and the grid problem. The grid is not ready for that. And the onshoring and all these things are going to create a huge demand for metals, in my view. And I think silver is going to participate that in a big way. And so, yeah, I mean, there's two ways you can look at this chart, the gold and silver. You can say, wow, what an opportunity. That's the way I see it. And there's other people that will say, well, this time is different, Tavi. Well, maybe the blue line is going to stay there because, don't you know that silver is not what it used to be in the past? I don't believe in those things. I bet on history. And if I'm wrong and this time is different, it is what it is. But I'm definitely not expressing, I'm expressing my view very strongly that the blue line is going to rise. And so, and I'm willing to take that bet with history on my side.
Tavi Costa emphasizes that soaring debt levels, accelerating geopolitical fragmentation, and the broader trend of deglobalization have created a new macroeconomic environment. This shift has reversed the dynamics of the previous cycle, now favoring tangible assets, diversified exposure beyond traditional financial centers, and a renewed focus on precious metals, particularly gold and silver, as foundational components of long-term portfolios. The shift began in earnest in 2022 when global central banks started significantly increasing their gold reserves. This movement was soon mirrored by retail and institutional investors, leading to a surge in inflows into gold-backed ETFs. As demand outpaced supply, the price of gold responded accordingly, marking the beginning of a robust and sustained bull market. Since October 2022, when gold was priced around $1,500 per ounce, the metal has surged over 125%, now trading above $3,400. Within just 1 year, gold has gained more than 50%, and over the last decade it has delivered a return of approximately 180%. In April 2025, gold reached a historic milestone, briefly touching $3,500 per ounce, its highest level ever. Analysts at Goldman Sachs expect this momentum to continue, driven primarily by persistent demand from central banks. They forecast gold prices to reach $3,700 per ounce by the end of 2025, with an upside to $3,880 if the U.S. economy enters a recession. Let's get back to the interview.
In fact, gold was in a bear market for
Mm.
basically the 80s, 81 all the way to 98, 99. In fact, it was down a lot during that period. People, that was the time when you saw these magazine covers saying that, gold was a pet rock and all these famous headlines at that period. And that's when the metal turned after that. So no, and in fact, I think the biggest thing that drove gold markets not to rally at that time was the fact that central banks were actually buying treasuries in a big way. Treasuries are so undervalued at that time. Imagine getting paid double digits in US treasuries and with inflation at its peak. And so a lot of central banks actually, in a very globalized environment, you've had a lot of institutions willing to purchase US assets in a big way, especially treasuries. That basically drove one of the largest bull markets in treasuries we've seen in history. But also, gold suffered at those earlier stages of that bull market. But yeah, this is why each of these cycles can be different. It doesn't necessarily mean we're going to see emerging markets doing well or Japanese stocks doing well. I happen to believe that in some, I have higher conviction in some parts of these asset classes and ideas that tend to work in a downward movement for the dollar. For instance, I'll give you an example. If you look within emerging markets, you have about, everyone talks about the rebalancing out of the US into other countries. But what about the rebalancing within the emerging markets index, right? 70+% of the index of MSCI emerging markets is actually from Asia. And so, as the world sort of shifts away from these manufacturing countries in Asia into other parts of the Western societies, I suspect that Latin America can be a much larger percentage of the emerging markets index alone. So I would be overweight that versus Asia if it was me. And so, but that's my bias towards how the cycle would work out. But there are plenty of ways, like for instance, you saw the dollar yen carry trade idea that developed over, 20, 30 years. Maybe we're on the verge of seeing something similar in emerging markets where you can basically borrow money in US rates to then return something in emerging markets yields. I mean, you have yields in emerging markets, some places well over double digits. And here in the US, you have all this pressure from the fiscal side, that could potentially cause rates to fall substantially, especially in the short end, allowing you to then borrow money in US dollar terms and then invest in other places outside. That was the beginning. I know it sounds crazy, but that was the beginning of the $10 carry trade, thesis. And it was exactly something related to that. So I believe, of course, in a separate way, right? You borrow in yen to then buy in US. So
Right.
I think that's going to be the case here. You have a world that simply cannot sustain a much stronger dollar, right? And I also think that government debt at those prior peaks that you're looking at in the screen, we're nowhere close to where we are now. And so arguably, that's one of the reasons why the dollar is sort of capped on how much it can run on the upside. And I really think we're going to see the opposite of the dollar milkshake theory. And I really do. I think that theory. I've subscribed to that view, by the way, and even Brent Johnson himself. We had many discussions about this, especially regarding China. If you go back to some of my stuff on China, you will see it. I was quoted on Bloomberg, very strong views on China is going to devalue and all sorts of opinions on the economy. And China was similar in that sense. Like you didn't know what asset was going to perform, meaning you knew that there was a bubble, you knew that there was a credit issue, and all these people at that time, it was funny because it was a time when it was very unpopular to say China was a bubble. Everyone thought China was going to take over. And I remember very well writing a paper that was extremely unpopular saying, I think China's closer to implosion than actually doing well. And so just to give you some sense, but I didn't know what asset would perform, meaning I didn't know if the way to express that view was equity shorts or bond shorts or that the currency was going to devalue. And you never know these answers, right? I mean, you kind of can see the thesis, but it's really difficult to pick which asset class will perform well. So we position ourselves in all these arrows essentially. And ultimately the equity side was one of the biggest ways to perform in terms of that. The currency did some movements as well. I'm telling you this because it's kind of the same way I see this trend today. You can see that the dollar cycle is turning. The big question now becomes, where do you invest? And so you have to be very open-minded to all these other ideas that tend to work in this environment. Which ones are those? It could be energy, it could be agricultural, it could be mining, it could be Europe, it could be Canada, it could be Japan, it could be Brazil. I mean, seriously, it could be South Africa. Nobody knows. It could be India, nuclear. So, I think a portfolio needs to be very well constructed in all these arrows. And it's not massive. I mean, all these arrows, it's very easy, not easy, but nothing is easy in this market. But it's somewhat there's a lot of evidence that we're probably going to be seeing capital flowing out of tech into those areas. And so I'm trying to operate under that assumption, and that's how investors do, right? And you have an assumption of the market, you express that view, and you see how that develops, and you can shape that view as you go, as you see more evidence of that thesis working out. The China thesis, there was a lot of signs when you start seeing the banks and the property developers one by one starting to fall. You kind of, you had to shift your point about, all right, maybe equities are going to be the way where the PBOC is going to allow this trend that is inevitable to unfold, because there's policy making, underneath this whole thesis as well. Like, what will policymakers do when they start seeing these macro changes in the environment? The same is going to happen with the dollar as well. And by no means I think the dollar is going to lose its reserve status. I'm not of that view at all. I just think that we're in a downward cycle for the dollar. This is not a end of the world call at all. It's just a normal cycle in macro, and that's all.
As precious metals regain prominence in global asset allocation, shifting economic undercurrents are redefining investment strategies. The consistent rise in gold's valuation and the awakening of silver from a prolonged dormancy reflect a deeper reevaluation of value amid escalating fiscal strain, industrial transformation, and geopolitical dislocation. These market movements are not merely speculative, but echo a broader systemic transition, one that increasingly favors tangible assets and diversified stores of wealth over conventional paper-based instruments. Silver, long overlooked, is now capturing renewed attention as both a critical industrial commodity and a monetary alternative with mounting strategic relevance. In light of these evolving dynamics, could silver soon rival gold, not just as a complementary asset, but as a central pillar in the architecture of future global finance? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.